Hello, quick video today. Wanted to follow up with my post from last week about growth and how picking stocks based solely on growth is not necessarily a good strategy. Question is, why is that the case? First, let me just reiterate that value and growth are not the same thing. You can check out a full video on my thoughts there if you look at this link, and also the link to my talk last week where I talked about the evidence about growth not being a very good investment strategy based solely on growth can be checked out here. Now, the question is, what's going on here? Growth is so appealing. You think about a company with growing revenues, growing earnings, they have the best products out there, the customers love them. I mean, the company is totally killing it. It's really appealing that these would be the types of companies that outperform going forward. But it's not, and part of the problems are expectations. There are tons of research out there that indicate that analysts and people in general are overly optimistic. Our crystal balls are not very good. I'm not going to read these to you. You can pause it if you need to. But again, there's just tons and tons of evidence out there that we have these lofty expectations that just aren't realized. All right. Now, the other thing you're telling me is, say, Brian, what are you talking about? I mean, growth, look at the last 10 years. Growth has been killing it. It's been doing a lot better than value. Well, first off, that may or may not be true. This chart would suggest that that's not true. Even if it is true, there are times, yes, there are times when growth will outperform. There are times when, CEOs with the middle name of that start with a J outperform too. They're just, but that's kind of irrelevant. But the point is here that we can go through long cycles where growth does do well. That's not really the point here. The point is to think about our expectations and how we can better utilize the growth information we have. So to kind of put that in perspective here, let's think about some examples where we have all these different companies, and we have expected growth rates. So these are the growth rates that the market has built into the price. All right, so we can look at two companies, A and B, that have expected growth rates of 10%, very high, very lofty. Let's say one of them turns out they only grow at 5%, the other grows at 12%. You can see that the market was wrong in different directions. That will result in different outcomes for the two companies. You can see this throughout here. Again, if the growth turns out to be better than expected, then the stock tends to outperform. So it's all about that difference, right? How expectations are different from what actually happens in the long run. And again, we talked about last time, this perfect foresight. You can see here that the four best companies in terms of their actual growth rate, companies B, G, H, and I, right? They grew at 12, 6, 7, 10%. These are the best growers, but expectations were very high for all of these companies, and only one beat expectations. This is a contrived example, but this is kind of what the data show when we actually look at the empirical evidence. So the key here is there's nothing wrong with growth per se, but you have to be different. That means from what the market expects in terms of your forecasting, and you have to be right. So you need to do that. And there can be cases, I'll go back here, there can be cases where a company is really not growing very well at all. So let's say company D, where we're expecting it to actually have negative growth rates, and it does, but those negative growth rates are better than what we expected, so that again can be a winner. So be correct, get your forecast right, be different than the market. That's how you're gonna play this growth game. Thanks so much for listening.